All right. I went live and I forgot to press live with the intro music. So instead of 2 minutes of intro, we're just straight into it. Matt, the mortgage guy at Residential Mortgage Broker, coming live every Monday at 3 p.m. Live Q&A. Any questions you have about real estate, about mortgage, I'm happy to answer. We've got all kinds of fun stuff going on this week. We got the Fed introducing increase to the Fed funds rate Wednesday. Their meeting and all that other stuff that precedes it. Great. But really what folks are looking for is that confirmation. They're going to hike 75 basis points. And then what they're going to say about what their plans are for future meetings, namely September. Folks love to prognosticate. Is that the word? And it will be a market mover, much less on what they do as far as the hike of interest rates, because that's almost a foregone conclusion that 75 basis points, but more what they say about future Fed rate hikes. And that will no doubt impact the market. So I got a bunch of different things that we can talk about today. We can talk about that. I just recorded a video reminding folks that the Fed funds rate isn't the 30-year fixed rate mortgage. Even with all this information out there, I'm still going to have folks say, I'd like to lock in my loan tomorrow before the Fed hikes interest rates. While it can have an effect, it's likely already baked in because we already know what's going to happen with that. What it is going to directly affect this week's meeting: car loans, student loans, home equity lines of credit that are tied to different indexes, adjustable rate mortgages, again, that are tied to some sort of different index, margin loans. On the positive side, I was looking at CD accounts and like high yield savings accounts. Those things are back up to like 1.5%, 1.75%. There was a time when the Fed funds rate was zero, so borrowing money was as cheap as it's ever been across a bunch of different things, but also yields on any sort of savings accounts were dismal, right? You could throw $100,000 into a high yield savings and get 0.4% or something ludicrous like that. So that will also go up as the Fed funds rate increases. They've stated their target is somewhere in the 3.25% to 3.5% range. Currently, it's 1.5 to 1.75. With this next hike that's coming Wednesday, it's going to be 2.25 to 2.5. If they do what they've talked about, raise the Fed funds rate by 0.75%. If you have no idea what that means, the Fed funds rate is essentially the rate with which the institutions lend to each other. When that rate goes up, no doubt the cost of capital across a bunch of different places, credit cards, student loans, goes up. It also, which I didn't talk about in my video, just because I didn't want my video that's coming out tomorrow to be too long, affects businesses, right? Businesses raise their prices when the cost of capital goes up because, they're borrowing money to run different parts of their businesses, to simplify it as much as possible, right? And so their cost to borrow capital gets baked into their, profit and loss. And in order to offset that, what a lot of companies do is they raise prices. So it's bad for, inflation. But where the raising of interest rates truly is going to pull down inflation, and Jerome Powell and the Fed has said this on many occasions, is it's going to really kill or at least pull down the demand side, which, since we're on a mortgage channel and we're talking about real estate, housing supply is up, buyer demand is down. Special shout out to my buddy Ryan Lundquist, who, I'm looking at his blog right now, puts out great data on that. SacramentoAppraisalBlog.com. He's going to be on, I believe it's August 19th. No. We're on Mondays. August 15th. I'm going to have him on live talking about housing market data. This guy does a great job, Sacramento and surrounding, really from all of real estate data. He's great at it, but that's what we're seeing right now. I was surprised too that some of the data that he put out, some of the data that Altos Research put out, and as I'm looking at it, it feels like a ton more inventory is coming to the market. But the joke's on me or anybody else that think it's some huge spike in listings. It's not. The reason why we have more inventory has a lot less to do with that and a lot more to do with demand side being pulled down, thus creating things staying on the market longer. And that's why we have more inventory. Interesting stats from the guys over at Altos Research. I watched a video earlier today. We were seeing like week on week, 6%, 8% increase in inventory. The inventory continues to increase, but at not as rapid of a pace, like a 3% week on week, which Altos Research, who does a lot of great stuff. You can check them out. Altos Research, they've got a plethora of real estate research and information online. Their projections are that, inventory is going to kind of level off. It's increasing now, but it's going to level off towards the end of the year like it always does. And they don't even think we'll get to 1 million listings, which is what would be considered probably average or healthy. And, it's kind of surprising to me because all these latest stats where inventory is just up a ton. Everybody thinks it'll continue to go up a ton. All the data shows that it's not from stuff hitting the market. It is actually from stuff just not selling as fast. So the inventory stacks up. Ryan, I won't steal it. I'll just post his blog here. You can check it out yourself. SacramentoAppraisalBlog.com has a great chart which shows what's going on with listings. And it surprised me, because to me, it feels like more listings, more inventory. It's actually kind of average or less than average listings, but stuff not selling as fast. So inventory is going up, which is, this is a cool chart. Let me share this. I shared the link to his blog and I'll just show it here just so folks can see it. To check out the full thing, you gotta go to SacramentoAppraisalBlog.com. But look at this chart real quick where he shows side by side. Share screen. Pended is the red line. New listings is the blue line. And trust me, I'll get it up here. Here it is. 2018, 19, 20, 21, 22. The new listings are less over these last 3 years than in an average year. A 2019, 2018, or 17. Pendings, especially from like 2020, 2021, are down a ton. This gap right here, I'm actually doing this on the wrong screen. This gap right here is what's creating all the inventory. Right? Because stuff is not pending nearly as fast. It's taking longer to sell. New listings are, for all intents and purposes, average compared to the last couple of years and lower than average based on all the prior pre-COVID years. So listings aren't up. Pendings are just way down. And this makes sense to me when you really think about it, right? Rates went up, really hindered folks' ability to afford housing, really affected, I think the stat was like 16 or 18 million that no longer qualified to buy, which is unfortunate, but it's the truth. And so demand has really fallen off a cliff. And I think that's something that if you're going to watch anything in real estate over the next 6 to 12 months, watch demand. Demand has been severely crippled with the doubling of interest rates, as you would imagine. When you step back and look at it, you're like, okay, that makes a lot of sense. If someone's mortgage payment goes up $800 or their purchasing power goes down $200,000, less folks are going to be able to buy. The other thing that surprised me when I was looking at stats, I'll pull up another one because charts are always cool. Redfin has pending sales, and this is all Redfin metros. The chart we just showed is Sacramento specific, the market I'm in, and the market that Ryan Lundquist does a majority of his stats in, Sacramento and surrounding. This is all Redfin metros and pending sales, which I thought was, I guess time will tell, right? Because This black line is 2022. And this data goes all the way till about mid-July, 7/17. Pending sales are down 13.3% year over year. But anything we compare to a super hot 2021, it's kind of tough, right? And 2020 had a lull during the onset of the pandemic. Then it really was ripping and roaring up here, and then August rates were super low and people were going bananas, right? But if you compare 2022 to 2019, a lot of the comparisons I like to do to 19 because it's the last quote unquote normal year, pre-COVID year, whatever the heck you want to call it. We seem to be following a similar trend line. And so are we going back to normal, or is this going to continue and trend down and go crazy lower than average? I think that's the $1 million question. I honestly don't have an answer for it. I think it's something that a lot of folks are going to be watching and paying attention to and trying to figure out going forward. So a lot of interesting stuff to watch. A lot of folks that I'm talking to on a daily basis who are treading lightly when it comes to housing. I've still got a ton of buyers that are out there looking to purchase. The good news for them is that there's more inventory. The sellers are more willing to negotiate. You're able to keep your contingencies in place. You're able to get, seller credits to kind of set up your financing and construct the loan to your liking. Meaning you can use seller credits to buy down the interest rate. Sometimes you're getting either breaking news in the comments. Monkeypox was declared a public health emergency on Saturday. I think this is a potential black swan event. I did not hear this, but if anybody can neither confirm or deny that monkeypox was declared a public health emergency, I heard, and trust me, I don't follow the news very close at all, just not my cup of tea, that monkeypox was some rare thing that only a small subset of folks were going to worry about. I don't know. I don't follow the monkeypox. It was declared by the World Health Organization. All right. Well, we gonna see, right? C. Smith, thanks for joining, man. I love the chart too. Sacramento Appraisal Blog. Go check out Ryan. As far as future episodes go, I've got Ryan on August 15th, and I think it might be next Monday. Is next Monday, August 1st. I'm going to have my buddy Mike Petrus from Idaho. I want to talk to him about the Idaho market. I want to figure out what's going on there. As I've stated here before, and I'll state again, different markets are going to be affected differently in the next 6 to 12 months. Idaho being one that just saw such explosive growth that if any market is susceptible to a larger correction, 25, 30% home price depreciation, it's a market like Boise, Idaho, or a market like some of the crazy explosive growth markets in Arizona or Florida or parts of Texas, right? If they went up 50 to 60% in the last 2 years, they could see a 30%, price depreciation. A market that's seen more normalized growth, likely to flatten, not likely to just fall off a cliff. But Boise, Idaho is one that I'm interested in seeing, just because I know, being in California, have a bunch of outward migration towards Boise. I'd love to hear from Mike's perspective, being a former Sacramentan that moved to Boise, what's going on in that market, what he's feeling, what he's seeing. Is inventory stacking up like it is in some parts of the country? Are folks starting to, see the change there? Kevin Hawthorne, good evening from Lakeland, Florida. Good to see you here. Thanks for joining. Everybody who's on here, do me a favor. Let me know where you're from, what you do, consumer, loan officer, real estate agent. Pump in the comments, the questions. Without the comments and questions, it's a harder Q&A to do. I really don't want to get on here and speak for 60 minutes. You know, I usually intro with 5-10 minutes of what I'm looking at, what's going on, this week's Fed funds meeting, and all the other stuff. But I'd rather have some back and forth Q&A. I feel like it makes for a better live, and it really creates great value. Whenever anyone asks a question, without a doubt, there's going to be a ton of folks with that same question. So, so I saw this up here, Black Swan event. What is a Black Swan event? That's a great question, because who was it? My buddy Eccentric brought it up. It's basically something that's like a super negative event, or something that causes, it's like impossible to predict, and something comes along and happens. In this case, Eccentric saying it's going to be monkeypox. It's unexpected, it's unknowable, that then, you know, creates a bunch of turmoil in markets. I think it's like, you know, stock markets and the economy in general. That's a simplified version. Somebody probably has a better explanation of it. Vanessa Castro, what's up? How you doing? Hope things are well. I live near Pismo Beach, California. What's up, Jason? Thanks for joining. I used to go to Pismo Beach back in like high school and college with friends. We'd go camping, go run around the beach and do whatever young Dumbos do. Monkeypox spreads between people primarily through contact with infectious sores, scabs, or bodily fluids. That doesn't sound fun. Robert Mitchell, thanks for joining, brother. Hope all is well with you. I think you're in AZ, right? Arizona. Another market that saw some crazy growth. It'll be interesting to see what happens over the next 6 to 12 there. Miss Shadows in Tampa. Florida's a wild market. Ramon Cisneros Cruz, how you doing? Thanks for joining. I appreciate it. Valued friend and client. Yeah, I think I did a pretty piss poor job of explaining Black Swan event, but it's like, you know, Brexit or the global financial crisis, the dot-com crash, those kind of things have a big effect on financial markets, you know, but they're not predictable. So an unpredictable event that happens that has an effect on markets. Hey, David Luna, sup? I don't know if you've seen this, Mr. Luna, but there is a stand-up paddleboard store in Folsom near an old office of mine. Stand-up paddleboard is SUP. So the name of their store is Sup. Reminds me of you. I just sent your team a message over there at Mortgage Educators. You guys got to do an event in Sacramento, Roseville, or Lincoln sometime. If I got to sponsor it for continuing education and get 80 to 100 people in a room, I'll do it. But David Luna, appreciate having you here, man. Appreciate you stopping by. A mortgage legend in the house. All right, here's a question we want to discuss right here. Derek Lee. Thank you for asking this question, Derek. I appreciate it, because no doubt other people are going to listen to this and they're going to get value from it. How long after the Fed's rate hike will the mortgage rates rise as well? I talked about this. I made a video. It's going to be live on YouTube tomorrow. Basically letting folks know that the Fed funds rate is not directly tied to 30-year fixed rate mortgages. This Wednesday, almost anybody who's putting a prediction on the table is saying the Fed will increase the Fed funds rate by 0.75%. We already know this. And when the markets know this, it's already baked into the mortgage rates that we see today. If today's rate is 5.5% on a 30-year fixed, the fact that we already know the Fed's going to do 0.75, when the Fed does it on Wednesday, it shouldn't necessarily affect that mortgage rate much at all. Where the mortgage rates may see volatility is when the Fed comes out and says, hey, listen, inflation was even higher than we expected. We think that we might have to increase them by this much in September and this much in the meeting after that. And instead of having a target of 3.25 to 3.5, we're going to try to get this Fed funds rate up to 5. They start talking stuff like that, stuff that, the market hasn't priced in or we haven't thought about. That's when mortgage rates start to trickle up. But just this Wednesday meeting happening will not necessarily have a negative impact on rates. There could very well be. I don't know exactly what happened in June. What day was that June Fed funds meeting? I feel like before the June meeting, rates had gone up quite a bit. I want to say that June meeting was late June. Rates probably came down after that meeting. Whatever the case, just don't listen to or buy into, I need to turn my loan in tomorrow and have it locked because Wednesday the mortgage rates are going up. Just not the case. West Sacramento. Is West Sac still super popular? People were flocking to West Sac because it was such proximity to downtown. All the building, all the money's being poured into downtown Sacramento. I had a time where I was looking at a bunch of real estate in West Sac, but that was 3 or 4 years ago. I probably should have bought all of it. Would have been a good call. What does my crystal ball say about Denver? I think the best markets with good paying jobs, with quality of living, because people can work from anywhere and whatnot. Like, I don't think that you are as at risk, right? Destination for remote workers in the tech scene, and higher than average appreciation, just like we've seen in Sacramento. My market might be comparable in some ways to Denver. I don't see Sacramento falling off a cliff. Maybe we get flat and we see, no home price appreciation in 2023. If I had to have a crystal ball, Joseph, it would be that Denver would go flat and wouldn't fall off a cliff like some of the other markets that have seen, I don't know, hyper appreciation, some would call it, right? 30% a year is crazy. All right, Theo B, another great question, because I'm getting this one too. I know when multiple people are asking the question that there's lots of people curious about it. Hearing more about assumable mortgages. If only it was this easy, right? Go out there and just find a seller that's got a 2.75 and just take over their mortgage. No problem. First problem is that conventional mortgages aren't assumable. So everybody that refinanced, I shouldn't say everybody, 70 to 80% of the refinances done in 2020 and 2021 to these historic lows of 2.5, 2.75% 30-year fixed were conventional. And none of those loans can be assumed. You can assume an FHA loan or a VA loan, but another thing to consider, you've got somebody with a VA loan from 2014 and they owe $327 and their house is worth $800,000. You'd like, I'd love to assume that low VA rate they've got. Okay, you just have to put down $475,000 to buy that house. No problem, right? Most folks aren't putting $475,000 down to buy that house. So it's not as common, not as easy, not something that I would be spending too much mental bandwidth worrying about or thinking about is assumable mortgages, just because they're just not going to be something that like happens at scale. All right. For all the loan originators who are on here, because I know I got loan originators that follow the channel as well. David Luna, Mortgage Educators, the best mortgage continuing education platform on the planet, will be coming to Northern California. It's on the calendar. I got to find it. If you're going to have to sit through 8 hours of continuing education every year, rather than sit in front of a computer, go get around a bunch of high-level mortgage pros, get around David's smiling face, his great jokes. And the thing about his class is he's actually going to sneak in great education, great things to think about in the years to come. If you're a mortgage lender in this market, you realize things are changing. And so, it's going to give some great insight, and I'll be there. West Sacramento will be rapidly developing within the next 10 years. I'm watching this area very closely. Get on the Planning and Development Commission. Let me know what's going on, Vanessa. I like to hear that. Oh, this is a good reminder, Matt. I've got to I'll put this on my YouTube as a question. If people think that the Fed's going to go 50 basis points, 75 or 100, I think 75 is probably like a 90% shot. And there's 5% chance that they go 50 and 5% chance that they go 100, but we'll see. I don't think there's any market moving data that the Fed could or would have seen to make them change course. If we got some crazy inflation, indicators where it's higher than we thought, and they're like, all right, we got to do 100. We got to go full throttle. Then maybe, but I don't think it's Stacy McKay, also in Pismo, a realtor. How is Pismo real estate doing, Stacy? I would imagine like Pismo Beach, a pretty popular place. Are people buying second homes and Airbnbs there? I mean, I'm sure they were in 2020 and 2021. What's the market like after? June 14th and 15th. So that was when. I'd love to hear, Stacy, on what Pismo's doing from you, but I'm going to jump to this one because this was in response to me asking when the Fed last had a meeting. It was, I knew it was 75 basis points, right? Back in June. I just don't remember the exact dates. It was the 14th and 15th. So watch this. I'm not the smartest tool in the shed, but check this out. Move down here. I'm going to share my screen and show you what happened to rates after the Fed announced a 75 basis point increase, which will be interesting to. All right, this is going to be an interesting thing. You guys give me your feedback. A lot of folks that watch, probably smarter than Matt the Mortgage Guy. Okay, so the Fed met in May, and there's a Fed increase in May. All intents and purposes, rates were fairly flat in May, right? Then the Fed met 14th and 15th. The 15th, they announced 75 basis point rate hike, and rates were up here above 6% for the first time. Literally like these 2 days prior, 14th, 15th. Then they announced the 75 basis point rate hike and rates come down. Very interesting. It's interesting to think about like leading up to that meeting. I remember one of these days was like the Friday before. Was it the 10th? Yeah, this Thursday, the 9th, Friday, the 10th, and Monday, the 13th was just like the wildest 3 days in mortgage rate history that I can recall. Can you imagine going from 5.5 to 6.28? Like 3/4 of a true rate increase. Now, see, now you're going to get folks that are like, oh yeah, see, there's the 75 basis points. It just happened before the meeting. Not exactly how it works. But we shall see. Now we're back to about 5.5. We've got the meeting the next 2 days, and we gonna see. My question made it to the video. Hi, Mom. Look, Ma, you made it live on the YouTube mortgage Q&A with Matt the Mortgage Guy. Joseph Swarodowski made it in the video. As long as I can, I'm going to try to answer as many questions I have. I had people talking smack to me, and I was even answering their questions. So benefit of a smaller channel is you're going to get all your questions answered, hopefully. If I don't know the answer, I'm going to say that, but I'm always giving honest feedback of what I think. I think this is a better format too. Every once in a while, I get some questions sent to me via email, whether it's somebody who watches me on YouTube or follows on some other social channel. The benefit of YouTube Live and doing Q&A here is sometimes I'll give feedback to a question, whether it's, hey, I'm thinking about investing in multifamily real estate, or I'm thinking about doing this. Not only can I answer it, but we can crowdsource other folks' feedback on it. There's folks in the comments that are fellow mortgage brokers, fellow investors, fellow real estate agents, and they can provide feedback on what they think. Jason Yates, is it hard in this climate to buy a house in Long Island, New York with a VA loan? By climate, I'm guessing, you're talking about the real estate market and, how fast things are trading or how competitive it is. The good news is VA loan, FHA loan, any government loan that, let's just say tell it how it is, had a harder time getting accepted in the markets that were absolutely bonkers from 2020 and 2021, where conventional lending led the charge. It was cash buyers. It was conventional, waiving appraisal contingency, doing 75, 100,000 above ask, all that stuff that made it more competitive or harder for VA loans or an FHA loan to get an offer accepted is changing very, very quickly to a market where you've got a very good chance. If you present a great offer, VA loans have always been a great loan. They're not hard to close. The reason sellers or anybody else has issues with them is probably more of them not understanding them. But nonetheless, if that was the case, that those offers were harder to get accepted, it's becoming easier. I can say that without a doubt across the country. We've got a bunch of FHA loans that historically have been popular among first-time home buyers, have just not been as prevalent over the last few years because it's been hard to get those accepted. Those are making a comeback. David Luna threw in 5.4% appreciation for Denver as a guess. And is that a 2023 number you're throwing out there, David? Or is that like year on year? For Joseph Swarodowski, talking about Denver. Okay. Are there still mortgage moratoriums active? I don't think so. Are you talking about like forbearance where people are able to go into forbearance agreements and not pay their mortgage for a number of months? Those have all but dissipated. Or if you're talking about a moratorium where you couldn't get foreclosed upon, I'm fairly certain those are done as well. I saw an interesting stat too, and I'm always open. Like, I'm not going to ever like stick to my guns or, hey, I thought this or said this and I'm sticking to it forever. Somebody pointed out something interesting to me in a comment section, and it was about the number of mortgages delinquent, which is another interesting thing to watch. And I think it was in response to a comment I made. You can't compare foreclosure numbers from 2021 to 2022, because in 2021 you just couldn't foreclose, moratoriums, right? And so if you see a 700% increase, it's because our base case is next to nothing. But as far as delinquencies, that will be something interesting to watch, right? The reason why it's very unlikely to see mass foreclosures is because if there's 1.2 million folks delinquent, but on average they have a big amount of equity, much less likely to foreclose. You could fire sell your house, pay off the mortgage, and net $100,000 and do whatever. That's a lot better option than foreclosing, right? So a short-term payday loan or something to get the mortgage current enough to where it's not going to default and fall into foreclosure. That is something that I think is going to prevent a big number of these delinquents to foreclose. What do we got here? Optimus Prime, $10 super chat. Thank you very much. If you guys didn't know, you could donate to the cause, and I appreciate the heck out of it. More than the monetary value of the super chat, I just get to go home to my 9 and 13-year-old and tell them that I'm getting super chats live on YouTube, which is just like street credit when you got 9 and 13-year-old. I appreciate you, Optimus Prime, and I appreciate the street credit I'll have around my house, being able to just say that somebody sent me a super chat. My first FHA loan, 3-family in the Springfield area. I have excellent credit and high income. Home is $350K and decent condition. How can I figure if I'm getting a good deal? I've got a bunch of feedback for you. I love the question. I love the fact that you're interested in investment property real estate. I love the fact that your first deal, which maybe it's not, maybe you've got others, is going to be a 3-unit. So you'll live in one and you'll rent out the other 2. My guess is, you're doing this because you can with an FHA loan, buy up to 4 units and put 3.5% down. So on this $350,000 purchase, down payment of roughly 10 or 11,000 plus whatever the closing costs are, all in, it's going to be less than 20 grand if you get any seller credit to buy down pay for part of the closing costs. You're all of them are better off. Okay, on to, I'm trying to pull up a spreadsheet for you, because how can I figure out if I'm getting a good deal? This, I think, is something that I'd pour some time into if I was you, get really clear on the numbers, albeit it's going to be your primary residence, because you can only buy it as an FHA loan if it's your primary residence. With putting that aside, look at it from an investment standpoint, because eventually it probably will be. You'll probably move out into something different, and then you'll rent 3 units. I would look at it from that perspective and try to come up with 2 different things to look at. One is you're going to buy it, and just for, let me pull up this spreadsheet so I can really be accurate. Pre-approvals. I've got somebody with a similar scenario to yours, so I know I'm going to be able to pull up their spreadsheet, and it's going to be close. I can't share it because it's got personal information on here, but I can tell you FHA 2 to 4 unit is popular because it doesn't require a lot of money down. All right, I just want to pull this up so I can get an idea of what your all-in is going to be payment-wise. Because for anyone else out there considering FHA multi-unit, you're going to want to come on. Where is... You're going to want to have an idea on these numbers as well. Okay, $350,000 purchase. I don't know about Springfield taxes, so I'm just going off of the tax rate in California, maybe higher or lower, but just for example purposes, right? Principal, interest, taxes, insurance. Again, I'm assuming that you're putting down 3.5%. So that's the minimum. Some folks put down more. You're certainly able to. Let's call it a $2,300 mortgage. Based on your taxes and all that stuff, it could be more or less. You want to know what the other 2 units rent for, and maybe it's $1,000 a piece. So you got 1,000, and you're able to live there for less than $400 a month. What you're going to want to wrap your head around is, when I move out, what is this going to look like from a cash flow perspective? More than likely, in most markets, rents are only going to increase. Also, if this thing is worth $500,000 in 5 years and you refinance it into a conventional loan and you rip off that mortgage insurance, your terms for the mortgage might even be better. So you might be winning in multiple ways. You might be winning in that your mortgage drops to $2,100 a month. You might be winning in that your rents go from $1,000 per door to $1,200. So now that's $3,600. But don't keep it as simple as that. Most investors will, where they go, oh, $3,600 a month in rents. I got $2,100 in a mortgage. This thing's a home run. It cash flows $1,500 a month. I promise you, it doesn't cash flow $1,500 a month. You might have property management. You might have water and sewer that's not covered by tenants. You cover it. You might have, I shouldn't say might, you will have vacancy. You will have capital expenditures. You will have other things. There's a great calculator, CDS calculator. I've got a video on my channel about this, but Chandler David Smith is a real estate investor in Idaho. Rental calculator. Put the numbers into this CDS rental calculator, Optimus Prime, and run it there. You'll know the purchase price. You'll know your all-in costs. You can guesstimate rents. And I'm saying run it without you in it. Some things change. I'm working with investors right now where if you're living there, you might have the option between like where you want to rent is $1,200 a month, or you buy this triplex, they each pay $1,000 and you pay $350. That's obviously a win, right? And you're into an appreciating asset with less than $20,000 out of pocket, and you're in it for future appreciation. You're in it for debt buy down. You're in it for all those great reasons. So I'm excited for you. It's great. It's a great way to buy real estate. It's a great way to get into rental real estate with low cash out of pocket. But it doesn't mean that every deal is a great deal, right? I would look at the areas that you like based on future appreciation that are going to have the highest demand for rents and for, higher quality tenants. I would also, do as much research as you can. Unlimited the amount of research you can do. Yeah, this is probably what most markets are experiencing, Gene. They're slowing. Price drops, which again, price drops doesn't mean price depreciation. It just means that like they started too high. They were unrealistic. They didn't realize the market was changing. Now they got to come back down to reality. Higher interest rates aren't helping sales. This is an understatement in all markets. Higher interest rates are killing demand. I showed you guys that graph earlier from Ryan Lundquist at Sacramento Appraisal Blog. Interest rates are crippling demand. Demand is crushed because affordability is crushed. Another great question. The 10-year Treasury note has been declining. Does that mean the 30-year mortgage will adjust downwards? It has been. Where did I put? I just had it. I just had that 30-year fixed rate mortgage chart up. Come on, baby. Over the last, let's call it couple weeks, that 30-year fixed that was floating around like 5.75 has come down to 5.5. And so that if you want to talk correlations, 10-year Treasury and the 30-year do essentially roll together to put it into simple terms somebody like me can understand. So I think the answer to your question is it has been. It's not dramatic, but it was 5.75 a couple of weeks ago. Now we're at 5.5, depending on the lender, of course. Not every lender is the same, but yeah, it looks like the 10-year is down to 2.8. So it was up well into the threes, has retraced back to 2.8, and interest rates have followed. They've gone from them peaking above 6 to in the mid 5s. Yeah, this is exactly the case, Jason, is like most people don't know about it. And so they're like, oh, I don't want to accept VA because of this. I don't want to do a FHA because they're going to have an issue with the condition. If your house is falling apart and it's a piece of crap, conventional lending is going to have an issue with you too, right? Health and safety, albeit like historically people think that FHA and VA are the only ones concerned about health and safety. Like conventional lenders and their appraisers care about that stuff too. So anyhow, I won't get more into that, but. All right, Rob Taylor, you ready for your daily dose of inspiration? What better time to get in the mortgage industry? If you're getting in the industry now, you have 0 loans in your pipeline. It's a hard time because demand is down. There's just less people out there getting pre-approved, looking to buy a house. There's next to nobody refinancing because those don't make sense. I would say if you're really passionate about mortgage, you're really passionate about helping people, get out there and do all the things that will create long-term success, providing value, really serving people. If in a year's time you've got some traction, you got some loans, you can survive in any market, and it's only uphill from there. If you can't, it wasn't for you, right? But to not start because you think it's a harder time than it was 2020, which you're right. I think that's probably a bad mindset to start from. When I started back in 2013, before I was even licensed, I was in an office talking to folks. That was like the taper tantrum, and rates went up like a full percent the summer of 2013. And I was trying to, like, as a junior loan officer, just learn and get deals. 2014, it took a lot of work for me to do 27 deals. And when I say a lot of work, I mean 3 networking meetings per week. I started doing a YouTube every single Monday. No one was watching. Nobody cared. I did more work than anybody around me and got 27 deals to the finish line in 2014. Then in 2015, I did 50 deals, which was almost double. And it continued to snowball like that because I put in a lot of work. If you are hoping to enter into a market where stuff falls from the sky and everything's easy, mortgage wasn't the right place for you anyhow, because the business can chew you up and spit you out and beat you down. It's tough. It's extra tough for people that extra care. And I'm realizing that with a lot of people around me, that I surround myself with people who really, really, truly care about the consumer, that really care about serving people. And when you have that mentality, everything hurts more. A client falling out of contract because of an issue with the house hurts you too. Missing a deadline because IRS couldn't get a certain document and everybody's screaming at everybody wouldn't affect you if you didn't care, and it affects you double if you care a lot. So the industry can be tough because it's the largest purchase of somebody's life. It can be stressful. It can be extremely rewarding. But anyhow, I went off on a tangent there. Best of luck to you. If you're good, you're going to survive and be better for it. If you're not good, you're going to find that out real quick. All right, that's that. Springfield, Massachusetts. I can't charge you, brother. It's against the rules. team@mtmg.com. Send me an email. We'll set up a call. I'll do a 15-minute call with you, Optimus Prime. I'm stoked for you. I love investment real estate. If it's your first deal, I'm extra excited for you. If you don't have one rental at a time, from my buddy Mike Zuber, on our call, I'll get your address. I'll send you that book. We'll get you started, man. It's going to be fun. You're going to look back in 20 years and be like, man, remember I bought that $350,000 triplex? I was only out of pocket for $16,250 for that thing. And look, I own it 20 years later. It's worth $1 million. Each unit rents for $2,200 a door. I've long paid that thing off after taxes and everything. I'm netting $5,000 a month. Better than most any pension you're going to get out there from any other company, right? Is that one triplex that you bought early on. I'm stoked for you. Let's do it. team@mtmg.com. A lot of stuff coming in there, so be patient with me, but I'll get you on the calendar for sure. Yeah, I think that's what I would do, Jason. You don't necessarily have to, because I think that like this thing could be a long-term home run as much as it could be a short-term home run. I think you run the numbers as if you're not moving into it, just to vet it as its standalone investment. I remember talking to a guy I like and respect a lot about me buying a commercial building. And I was saying like, listen, I want to be close to home. I'm going to pay rent to myself through the business. And so like, I didn't need to vet it as an investment. He's like, but you still should. I think it applies the same here, where you're going to live there and you're going to have two people. You're going to be essentially house hacking, right? But why not run the numbers as an investment? Why not let it stand alone and be its own investment? I wasn't thinking like that back in 2006. Me and my then fiance, now wife, we're like, hey, we want to buy a house. Buying a house sounds a good idea. Bought it, had two roommates. Maybe if I'd ran the numbers as an investment looking back, I'd have been like, this thing's a negative cash flow. I would have probably looked harder and found a better deal. Nonetheless, like, I think it's good exercise to do, especially if you plan on buying investment property in the future. Nice. Congrats. Bought a house in Rockland, California. Great neighborhood. Cheers to you for that. Did you buy it with 100K in equity, or you have good equity now of 100K? If you bought it then with 100K in equity, cheers to you, because over the last year, you've seen another 15% appreciation. Jeff M., thanks for joining. Let me know where you're at, Jeff. I'm interested to hear. Will real estate ever come down in price? Cash buyer here, starting to really lose confidence in the system. Prices are still outrageous. I mean, to be super straightforward with you, prices are higher than they were in previous years. We all know that, but people are literally finding deals and ways to add to their rental portfolio every single day. Investors are probably not hitting home runs, but I know there's singles and doubles being hit. I know that when things were bonkers last year, my wife and I bought a property. When things were bonkers in 2020, we bought a property. In 2022, I put in a couple offers and not got them accepted, just because like what makes sense from an investment standpoint versus what the seller's willing and able to sell at haven't come together. As we've seen, as we looked at stats where demand is down a ton, sellers, they're going to see how much they want to sell when not as many people show up to their party, right? When they go from having 10 offers to choose from to 4 to 2 to just your one, you're going to continue to see more and more leverage. Found me from One Rental Time. Thanks for stopping by, man. That's my 2 cents. St. Louis, Missouri. I don't know much about that market. I actually know somebody who's doing apartments in St. Louis, Missouri, and I think he also does care homes, but not single family stuff. So I don't know. I mean, maybe there's different parts of St. Louis where single family doesn't make a lot of sense, but you could buy a triplex or a fourplex that makes a lot of sense. Yeah, I mean, I get it. The low end is gone and there's just like so much demand, but maybe this forces you to go out there and learn more about a different market segment, right? Maybe you go look at a certain class of Airbnb, again, like some places are overly saturated with that. So that might not be the answer. I'm just saying, start to look at other things besides what you were looking at before. If you were looking at just the bottom end, and what might happen is you might change your strategy. You might change what you're looking at or looking for. I know me personally, I bought real estate in the past that doesn't even really serve what the new goal is. I don't need $300 or $400 a month in cash flow. That doesn't serve the goal. What serves the goal is real estate that appreciates, that's in better neighborhoods, that's going to be a wealth building tool versus like trying to replace a job. And that's where everyone's goals are different, and getting clarity on that is like, do I need $3,000 a month in cash flow so that I can quit my day job and start doing other stuff I'm passionate about? Or do I want to create long-term wealth where time, money, and effort I invest right now turns into a $10,000 or $10 million nest egg down the road? It's different for different folks. When the goal is different, the things you're looking at are different. Joey Garesti, thanks for coming, man. Late, but better late than never. I think the live is now complete. Now that you're here, so thanks for coming by. Thanks for mentioning the podcast. It's Get Better Every Day, which, you know what? I never posted those links. I should do that. You are right. Podcast links. Knowing me, did I ever? I can't even find them. Last Friday, episode 1. Wait until you hear episode 2, Joey, coming out this Friday. It's gonna be cool. A buddy of mine that I love and respect a ton, that I talked to about all the cool stuff he's got going on. He's got some syndication stuff, ground up construction on a hotel in Texas, buying and building the hospitality brand in different hotels. So Get Better Every Day is the podcast. It's live on Spotify, Apple Podcasts, everywhere you can find podcasts. I'm going to try to find the link, because I know that when a podcast is brand new, we don't have reviews yet or anything like that. It's going to be a lot harder to find. I don't know. I can't find it. Hopefully somebody else can find and post the links. I'll post them in the description of this video, I think, maybe. All right. I'm just looking for a primary residence. Yeah, I mean, stuff's more expensive. That's for sure. It's tough. I try to give honest feedback on what the best course of action is. For everybody, it's different. If you're able to buy, I think what a lot of folks should consider is, let's say that whatever that price is for a home in the area you're looking at is $400,000, and you're really, upset. She's like, man, I could have bought that place for $225 4 years ago. It's not going back to $225. I'm 100% certain of that. Could it go to $375 in 12 months? Maybe. But I think when you're willing, able, and in a good financial position to buy, trying to time the market could be a mistake. You might wait 3 more years. And what if it doesn't go down? What if it goes flat next year and then goes up 5%? Now you're looking at $420,000. Now you got 2 years where you weren't paying the debt down on the mortgage. You got 2 years where, who knows what's going to happen to rates. I don't necessarily see them being higher, but I don't think you'd be FOMOing into it, especially if you've already shown some patience. Continue to show patience. Look for a great deal. I think that I'm working with clients right now that are getting into really great real estate deals where they've got a buffer built in, because in this neighborhood, they're buying something for $485 that needs a little bit of work and would be worth $550 or $575. So in the best neighborhoods, I don't see there being a 10% price correction. I don't see there being a 20% price correction. But what if it happens? What if they buy this place at $485 and we see 10% price appreciation for something that's worth $550 the day they buy it. Then it's worth $495. They're paying down the mortgage. They're in it for the long term. Your primary residence isn't something where like you're going to worry about. I mean, I felt like I was FOMOing into something in 2020. We paid $460 for. I was thinking to myself, like, gosh, listed for $430. We offered $460. It appraised at $430. I thought I was out of my mind. And now it's worth $600. If it goes down to $540, if we see a 10% correction, it's cool. If it goes up to $650, cool. It doesn't matter, right? It's something that the wife and I are going to own for 20 years from now. So less timing the market, more time in the market. That's my final advice. Thanks for watching, folks. Hope you got some value out of this. Join me next Monday. We're going to have a real estate agent from Idaho talking about that. August 15th, I'm going to have Ryan Lundquist, but every Monday, 3 p.m. Pacific Standard Time, live Q&A, giving you my honest feedback. Now more than ever, the real estate market is changing like crazy. And so we're going to watch it. We're going to talk about it, and we're going to crowdsource the best information about what to expect, what's to come, and how we're going to navigate this wild and crazy market. Thanks for watching. Until next time, we gonna see.